everyone. Welcome to the class of financial institutions and capital markets. Today we're going to discuss Chapter 6, Bond Markets. This is the outline of Chapter 6. There are mainly 5 main parts of the chapter. The first one is bond market securities. The second part is bond market participants. The third one is comparison of bond market securities, and then we also discuss international aspects of bond markets and euro bonds, foreign bonds, and sovereign bonds. But the most important part is actually here, in bond market securities. All the others are not very important. And under bond market securities, we're going to discuss treasury notes and bonds, municipal bond, corporate bond, bond ratings and interest rate spreads, and bond market indexes. And the key thing here is still treasury notes. As treasury notes basically takes up the biggest market share in the bond market. So there are 4 learning goals in this chapter. One is to describe the major bond market. Second one is to identify the characteristics of various bond market securities. So this learning goal 2 is the main learning goal for this chapter. The third one is to list the major bond market participants, and the fourth one is to describe the types of securities traded in international bond market. So now let's start with an overview of the bond market. As we discussed before in the previous chapter, money market, equity and debt instruments with maturities of more than 1 year are traded in capital market. If they are below 1 year, then it's in the money market, as we discussed in the previous chapter. So starting in this chapter, we look at bond markets. In chapter 7, we look at the mortgage market. Here, this chapter we're actually going to skip it because we don't have enough time. Then in chapter 8, we study equity market. So, but we are going to have a look at the equity market or the stock market and the bond market, but we'll skip the mortgage market for this course. Bonds are long-term debt obligations issued by corporations and government units. We all know what bond is, right? Unless it's perpetuity that was issued like by a British government at one point. Excuse me. Basically, all corporate bond has a maturity, because no one would believe that they will exist forever, right? So basically, bond is a termed debt obligations issued by either the corporations or government. Proceeds from a bond issue are used to raise funds to support long-term operations of the issuer. Yeah, the issuer, no matter whether it's the company or the government, they are in the demand of money, so they issue bond to borrow from the investors, and then they promise to pay back with a certain interest rate at a certain point in the future, right? So that's basically the definition of a bond. In return for the investors' funds, bond issuers promise to pay a specified amount in the future on the maturity of the bond, which is the face value, plus the coupon interest rate on the borrowed fund, which is the coupon rate times the face value of the bond. So if the terms of the repayment are not met by the bond issuer, then the bondholder or the investor has a claim on the assets of the bond issuer. Yeah, so that is if the bond issuer default or they are in financial distress. If they couldn't pay back, then the creditors, the investors, or the bondholders can ask the company to pay back the money. If the company has no money to pay back, then they can demand that the company goes into bankruptcy, and then they will liquidize whatever asset they have to pay back their creditors or the bond holders. So bond markets are markets in which bonds are issued and traded. There are mainly 3 types of bond. The treasury bond, including treasury bill, but treasury bill is the one in the money market because their maturities are below 1 year, right? And then So in the bond market, we discuss treasury notes, where which has a maturity between 1 and 10 years, and then treasury bond, which has maturities of longer than 10 years. Then we also discuss municipal bonds and corporate bonds. So this graph here shows you the bond market instrument outstanding between 1994 to 2018. So you see that basically the market share hasn't changed much. Treasury bond in 1994 takes about 40%, was the second largest in the market. But in 2018, it becomes still the second largest in the bond market, but its market share has increased to 43.5%. And then the corporate bond is the largest, which takes about 44%, and then the municipal bond is about 12% in the bond market. So, but of course, the total amount outstanding in the market has increased like 5 times over the past 30 years. So let's have a look at the treasury notes and bonds first. So the treasury notes and bonds, also are called T-notes and T-bonds, are issued by the U.S. Treasury to finance the national debt and other government expenditures. The total amount outstanding in 2018 was $13.2 trillion. The national debt reflects the historical accumulation of annual federal government deficits or expenditures minus taxes over the last 200 plus years as follows. So G is the government expenditure, or government deficits minus taxes. So this is how much government receives, this is how much government spends, and then the difference is the national debt, but of course accumulated over time. So this graph here shows you the composition of the U.S. national debt. So you see that the biggest part is the federal debt, of course, but T-bill is about, in 1994 it's about 15%, in 2019 it's about 10%, but the market share is relatively stable over years, so it's like in between 10 and 15%. Then treasury notes and bonds are always the largest part, takes more than half most of the time. Well, not in 2000 and 2008, but in 2019 it takes up like 62%. And then the other government account securities are about anywhere between 25% to 45%. Then the rest are others. So so this is the composition, but this is not very important, so you can just have a look at it. And then treasury notes and treasury bonds are backed by the full faith and credit of the U.S. federal government, and are therefore default risk-free. They will never default unless the U.S. federal government collapses. So T-notes and T-bonds pay relatively low rate of interest to investors because of their low default risk and low liquidity risk. T-notes and T-bonds pay coupon interest semi-annually. As long as you see it's treasury notes or treasury bond, you know they're always compounding every 6 months, so they pay interest semi-annually. This is something you have to keep in mind. In questions, I won't always tell you that it's compounding semi-annually, but whenever you see T-notes and T-bonds, just remember that, I have to remember to compound it semi-annually. And T-bills have an original maturity of 1 year or less, so this is what we discussed in the previous chapter, money market. While T-notes have an original maturities from over 1 to 10 years, while T-bonds have original maturities from over 10 years. Like T-bills, once issued, T-notes and T-bonds trade in very active secondary markets. And Treasury issue 2 types of notes and bonds: fixed principal and inflation indexed. So fixed principal is the one that most people know, right? So the principal, the face value is fixed for all its maturity years. But inflation indexed will adjust its principal according to the inflation level. So, but both types pay interest twice per year because they all compound semi-annually, right? So they all pay interest twice a year. Principal value used to determine the percentage interest payment, which is coupon, on inflation indexed bonds is adjusted to reflect inflation. Yeah, so inflation indexed bond will adjust principal value to reflect inflation measured by the CPI, the consumer price index. In other words, the semi-annual coupon payment and the final principal payment are based on the inflation-adjusted principal value of the security. We are actually going to discuss a type of security like this. We call it TIPS, the Treasury Inflation Price Protected Security. So, but we're going to discuss it later. And prices are quoted as percentages of the face value on the Treasury security, while coupon rates are set at intervals of 0.125, which is like 1/8 of 1%. So for example, here you can see this is the Treasury notes and bonds was traded on Monday, May 23rd, 2016. So you see this is the coupon rate, and all these coupon rates are like multiples of 1/8, right? And this is the bidding price, this is the ask price, and this is the change in the ask price, and then this is the yield. Yeah. So bid is the close of the day selling price in percentage terms available to T-notes and bondholders, which means the price dealers are willing to pay T-note and T-bond holders for their treasury securities. Yeah, so this is the price that brokers buy from those investors. Ask price is the close of the day purchase price available for investors. And so this is the price that brokers sell to investors. Yeah, so in this case, ask price will always be higher than bid price because brokers need to make money, so they buy it at a relatively low price and then sell it at a relatively high price. And the change is the change in the asked price from the previous day's close. Asked yield is the asked price converted into yield to maturity, which is the interest rate using semi-annual compounding that makes the security price just equal to the present value of the expected coupon and face value cash flows on the bond. Yeah. So you're considering the purchase of a $100 face value bond that pays 0.875% coupon interest per year, paid semi-annually. So this is like how much you would get paid if it's a $100 face value and the interest rate is 0.875. So that means the face value times the annual interest rate divided by 2 because it's paid semi-annually. So this is what you get, about 44 cents, right? The bond matures in 281 days and has a face value of $100. So the question asks if the current market price of the bond is $100, 17.97 cents. What is the yield to maturity, right? So this one is asking you to calculate yield to maturity, which is the I/Y in the financial calculator, right? So in order to calculate the yield to maturity, we have to know all the other 4 factors, right? So N is number of years in this case, not number of years, number of period, but because each period is 6 months, so therefore we have to convert these days into years and then times 2 to get N. Yeah. So I/Y yield is the one that we need to calculate. The third one is present value. Present value is the price, right? So this is the market price, this one. Then payment is this one, paid semi-annually, the interest payments. And then the face value is $100, right? So basically now we know everything we need to calculate. The only thing that you have to be extra careful, as I said before, is that always keep in mind that whenever it comes to a treasury bond and treasury note, well, here it's not, they didn't say anything about treasury bond or note, but it has explicitly told you it's semi-annually. So therefore you have to remember to convert everything into semi-annual computation. But if it doesn't tell you and it just says treasury note or treasury bond, you have to remind yourself, you have to do it semi-annually. Yeah. So PV is the price, F is the face value, N is the number of days divided by 365, and then times 2. It's in the bracket, that's why you see it's divided by 2, but in actual sense it's actually times 2. So this is the number of 6 months in the period before maturity, and then payment is this amount. Remember, this is the annual interest rate, coupon interest rate. Then you have to divide by 2. Then you get the payment for every 6 months. Then you can calculate the yield. But that's still not the end. After you calculate the yield, remember that's the yield for 6 months, not the annual yield to maturity. So the answer is you will get 0.32% semi-annual yield to maturity, but then you have to convert it into annual yield to maturity, which means you have to times 2. So that gives you 0.64%. Yeah. So separate trading of registered interest and principal securities is what we call strips. Strips is a type of security that is quite important. You see, I've highlighted it. So this is a treasury security in which the periodic interest payments is separated from the final principal payment. Yeah, so what does it mean? It means that for standard treasury security, it always has 2 parts. Interest payments for every 6 months plus the principal payment in the end, right? But strips is the one that it's kind of innovation that separates the final principal payment from the periodic interest payment. How can they do it? Let me explain. So each of the components of the strips are often referred to as Treasury Zero bonds or Treasury Zero coupon bonds because investors in the individual components receive only the single stripped payments in which they invest. Yeah, so they no longer receive like multiple cash flows or payments. There's only one single payment that they receive. That's the one that they buy or invest. Strips are created by the U.S. Treasury in response to the separate trading of Treasury security principal and interest that had been developed by securities firms. So it may be used to immunize against interest rate risk. Yeah, how does it how is it able to be used to immunize against interest rate risk? This is an illustration. So you see this graph here shows you how can you make a 10-year treasury bond into several strips. Yeah, because it's a 10-year treasury bond and they pay you interest payments every 6 months. So therefore you have like 20 interest payments, right? So this is from cash flow 1 to cash flow 20. Every period you receive a coupon payment, half of the coupon, annual coupon payment. That's what it says. Half of like 0.5 times C. So this is like annual coupon payment divided by 2. Then in the end of the 10 years, so that's the last cash flow. That's the 21. 21's cash flow is the principal, so the face value. And in actual sense, these two are actually paid together, or not really together, but like on the same time, right? Because they are all paid in the end of the 10 years. But we still try to separate them because we don't want to mix up the interest payments with the face value, with the principal. So this is an example of the U.S. Treasury strips that were traded on Monday, May 23rd, 2016. So you see that's the maturity date, this is the bid price, this is the ask price, and then this is the change, and then this is the ask yield. Yeah, and then the first panel is the Treasury bond stripped principal, and then this one is Treasury note stripped principal, right? So that's why you see Treasury bond all have much longer maturities, while Treasury note has relatively shorter maturities. Yeah, and then the last part is the stripped coupon interest. Yeah, so the first two are all principal, while the last one is coupon interest. Here's an example of strips to help you better understand how does this thing work. So suppose the Treasury issues a 5-year Treasury note with a par value of $10,000 and an 8% coupon rate. This 8% is an annual coupon rate, so every 6 months, paid semi-annually, every 6 months you receive half of the annual payment, right? So that's only $400 is paid to investors every 6 months for the next 5 years to Citigroup. Citigroup decides to convert the bond into a set of stripped securities by requesting the Treasury to separate the coupons and face value of the notes into separate securities on its computer system, basically giving each coupon and face value a separate ID or CUSIP number. Yeah, so it means that they become completely different securities that investors can buy separately. Then this means that the Citigroup can then sell 11 different securities. Why are 11? It's because it's a 5-year maturity Treasury note, right? So there are 10 securities associated with each of the semi-annual coupon payments of $400, and then the last one that pays $10,000 face value in 5 years to outside investors, right? So in total, it should be 11 different securities. So what are the value of each of these securities, assuming the yield to maturity on each of the stripped securities is 7.9% and is the same as the bond sold whole, right? So this is basically the market interest rate, right? 7.9% is the market interest rate, considering all the inflation risk premium, maturity risk premium, etc. Right? So if the market interest rate is 7.9%, then what should be the price or the fair value of the securities? This table here shows you the maturity on the security and then cash flows received on maturity. Basically, the first 10 are all interest payments, right? They are all $400, and the last one is the principal. So the maturities on securities is like every 6 months, so every half year. Yeah, and then the last column shows you the present value of cash flows at 7.9%. I copied this table from the textbook, but I don't know whether you have done the calculations yourself. I did it myself, and for the first time I didn't get the numbers correct, and I was very confused. I did use the 7.9%, but how come my numbers are very different from these numbers? So I strongly recommend you to do the calculations yourself and see whether you can get these answers. And if you can't, do you know why? What's the reason why you can't replicate these numbers? I'll tell you in the next slide. So maybe after this slide, and I'll let you know the answer. So notice that the total present value of the 11 different securities involved with the strips is the same as that of the original T-note before it is stripped, which is $10,040.65. However, this price is the total present value here. This is the same as the total present value. However, in general, the bank, which is Citigroup here, will try to sell the 11 stripped securities for a greater total present value than the bond as a whole. The reason for this is that many investors desire particular maturity zero coupon bonds to meet investment goals and needs. Such goals and needs are often harder to achieve through buying whole Treasury notes or Treasury bonds. So consequently, investors are willing to pay a higher price and thus accept a yield lower than 7.9% on the stripped investments. As a result, the total price Citigroup would get from selling these 11 strips would exceed the total present value of all those cash flows. Basically, in one sentence, Citigroup is not just doing this separation for free, right? It involves people, involves time and energy to do all this work, right? So, in other words, they ask for a premium for this separation, for stripping this security. And then suppose that it is 2022 and an insurer must make a guaranteed payment to an investor in 5 years, 2027. For simplicity, we assume that this target guaranteed payment is 1.48 million, a lump sum policy payout on retirement equivalent to investing 1 million at a semi-annually compounded rate of 8% over 5 years. To immunize or protect itself against interest rate risk, the insurer needs to determine which investment would produce a cash flow or exactly $1.48 million in 5 years, regardless of what happens to interest rates in the immediate future. By investing in a 5-year maturity treasury zero coupon bond or strips, the insurance company would produce a 1.48 million cash flow in 5 years, no matter what happens to interest rates in the immediate future. So basically, that's the meaning or the why strips are useful. Given the $1,000 face value and an 8% yield, and assuming semi-annual compounding, the current price per 5-year strips is $675.56 per bond. How do we get this price? Yeah, this is very important actually. So price is calculated like this, but this is with an equation. If you don't use an equation, it's also easy to calculate. Yeah, so how to calculate it? Remember, this is just the strip, right? It's just the principal itself, right? So assuming semi-annual compounding means that this 8% yield is annual yield. So for every 6 months, the yield should be 4%. And this is the face value, which is FV. And then this is the 4 is the yield. And then the number of years is 10. So 5 times 2, right? So that's 10 years. And then PMT is 0, right? So therefore, you can calculate the PV should be this one, 675.56. So that means if the insurer buys 1,480 copies of this bond at a total cost of 1 million in 2022, this investment would produce $1.48 million on maturity in 5 years, right? The reason is that the duration of this bond portfolio exactly matches the target horizon for the insurer's future liability to its policyholders. Intuitively, since the strips pays no intervening cash flows or coupons, future changes in interest rates have no reinvestment income effect. Thus, the return would be unaffected by the intervening interest rate changes. So basically, that's why the company, the insurer, should buy these strips. Okay, here are some other exercise questions. This one asks, an 18-year treasury bond can be stripped into how many separate securities? So this is an 18-year, right? And remember, treasury bond always pay interest payments twice a year. Therefore, how many interest payments does it have? That's 18 times 2, right? So that's 36, plus the principal payment in the end of the 18 years. So that will be 36 plus 1, so should be B, 37. Yeah, so D is the correct answer. The other one, you buy a principal strip maturing in 5 years. The price quote per 100 of par for the strip is 75.75%, which means if the face value is $100, then the price right now is $75.75. Using semi-annual compounding, what is the promised yield to maturity on this strip? Yeah, so the key thing here again is that remember it's semi-annual compounding, right? So this is PV. FV is 100, PV is negative 75.75. And N should be 5 times 2, so that's 10, right? And then PMT is 0 because it's only principal strip. So now you can calculate the interest I/Y. But remember, the interest yield you calculated is only for 6 months. Therefore, after you calculated that, remember to times 2. Right? Yeah, so this is PV, this is FV, PMT is 0, N is 10. So then you can calculate the yield should be 2.816%, and then times 2, you get 5.632%. So correct answer should be A. And then another example question. For the principal strips maturing in May 2017, the asked price at the close on Monday, May 23rd, is 99.244%. So we can actually see it from the table here. This one, sorry. So it's this one, yeah. So the ask price is 99.244. Yeah. So based on this ask price, settlement occurs 1 business day after the purchase, so you receive actual ownership on Wednesday, May 24th, 2016. When the strip matures on May 15th, 2017, which means it's 0.97534247 years, and you can calculate it yourself using the number of days divided by 365. The strip's holder will receive 100% of the face value or the future value. And using semi-annual compounding, what is the yield to maturity or asked yield? So in this case, remember, this is the price, right? And if that's for the face value of $100, because this is percent, right? So in this case, the PV is negative 99.244, FV is 100, and then N should be this is the number of years, and then because it's semi-annual compounding, right? So we have to use this to times 2, and then this is principal payment, so PMT equal to 0, and then therefore you can calculate the yield. But remember again, this yield is for 6 months, so you have to times 2 in the end, right? So N is that number times 2. This is the number of half years during the maturity. And then this is PV, PMT is 0, FV is 100, and then you can compute the interest. The yield is 0.3897, and then times 2, you get 0.38%. Yeah, so that's the key thing here is always remember using semi-annual compounding, and after you calculate it, always remember to multiply it by 2, then you will get the annual yield. Okay, so basically that is strip. I will leave the rest for our next class. Thank you all for attending the class today.